The impatient investor who believes they are long-term. Introduction. Many investors proudly describe themselves as long-term oriented. They claim to believe in compounding, business fundamentals, and patience. Yet their behavior tells a different story. They check prices daily. They panic during corrections. They compare performance weekly. They switch strategies every few months. This research explores the psychology of the investor who thinks they are long-term, but behaves impatiently. 1. The identity versus behavior gap. 1.1 Self-image as a long-term investor. Long-term investing is associated with discipline and intelligence. Influential figures, like Warren Buffett, have popularized the idea that patience is a competitive advantage. As a result, many investors adopt the label. But identity is not behavior. Saying, "I invest for the long run," is easy. Tolerating 2 years of underperformance is not. 2. The psychological drivers of hidden impatience. 2.1 Myopic loss aversion. Research by Daniel Kahneman shows that frequent exposure to short-term losses increases risk aversion. An investor may claim a 10-year horizon, but if they check their portfolio daily, their emotional horizon shrinks to 24 hours. Monitoring frequency often defines real-time horizon. 2.2 Social comparison pressure. In the age of social media and financial news, others appear to outperform constantly. New opportunities emerge weekly. Market narratives shift rapidly. The investor begins questioning their strategy after a few months. Impatience disguises itself as optimization. 2.3 Action bias. Humans are wired to act. In uncertain situations, doing nothing feels irresponsible. But markets often reward restraint. The impatient, long-term investor rebalances too often, sells during temporary drawdowns, buys into trending assets mid-cycle. They interpret movement as progress. 3. Behavioral patterns. An investor who believes they are long-term but acts impatiently typically holds assets for 3 to 9 months, changes thesis before fundamentals change, reacts strongly to quarterly earnings, exits during boredom, not breakdown. Boredom is one of the biggest threats to long-term strategy. If an investment does not deliver constant excitement, conviction weakens. 4. Market history as a patience test. Major historical drawdowns, such as the 2008 financial crisis, tested investors' real-time horizons. Many claimed long-term commitment. Few held through 50% declines. True long-term behavior is revealed during discomfort, not stability. 5. The cost of impatience. 5.1 Interrupted compounding. Compounding requires uninterrupted time exposure. Switching strategies resets the growth process repeatedly. 5.2 Transaction costs and taxes. Frequent adjustments erode returns silently. Small leaks compound negatively. 5.3 Emotional exhaustion. Constant monitoring creates anxiety, decision fatigue, reduced conviction. The investor becomes reactive rather than strategic. 6. The illusion of long-term thinking. There is a subtle difference between believing in the long term, behaving in the long term. The first is philosophical. The second is behavioral. A true long-term investor defines clear thesis, measurable exit criteria, acceptable volatility range, minimum holding expectation. Without structure, long-term becomes a flexible excuse. 7. How to align identity with behavior. To become genuinely long-term, reduce portfolio checking frequency. Define evaluation intervals, e.g., quarterly, annually. Separate price volatility from fundamental change. Accept underperformance phases. Build a written investment thesis. Patience is not passive. It is structured restraint. Conclusion. The impatient investor who believes they are long-term lives in a psychological contradiction. They admire patience, but practice urgency. Markets do not reward stated time horizons. They reward lived time horizons. In investing, your real strategy is not what you say. It is what you tolerate.